Okay. Let's see. Okay. Good afternoon, everybody. Bobby Piton here with Preactive Investments. And I'm going to go over a few things. I'm going to share my screen here in a second because I'm going to go over a few, we're going to go over General Motors that just recently reported. We're going to go over Tesla, which reported last week. And then we're also going to talk about Robinhood, which is a new IPO, and go through the filing on that report. And so right now, I'm going to switch over to my screen here. So I'm going to share my screen. Hold on a second. And okay. So hold on one second. We're going to go to the filings. Okay. So right now, if you give me 1 second, I just want to copy this link and then share it on Telegram because we're switching over our system to hopefully be a little higher quality, as well as I guess a little more automated. So I apologize for the delay, but we've been working on getting this switched over this morning. I want to be sure that we kind of go through these companies and how things are looking. So let me post that and live. Okay, live now. Okay, copy. Okay, and then let me see. I put it onto here as well. So I hope everybody is having a wonderful day. General Motors is down, I think, about 8% or so on the day. And Robinhood, believe it or not, was up over 60% at one point in the day, and actually had to halt trading. So it's very fascinating to see how these new IPOs and companies like Robinhood are having these types of parabolic moves. And so what I'm going to do is let me see here. I'm going to share this screen right here. So let's start with General Motors. So General Motors, if you look, if you go to sec.gov, you can go there anytime you want on any company if you want to understand what's taking place. And you can see, I'm just going to pull up a quick quote and just show you. The stock is having a little bit of trouble today. It's down about 8%. And the company is worth $77 billion. You can see that right here. That's the market cap. And it's doing $122 billion in revenues, is what it's showing, 155,000 employees. But we're going to go to, okay, that's Tesla. Just want to make sure we pull the right one here. That's Maxim, but Maxim doesn't have anything here. Did I just lose my filing? I have too many filings open, folks. Okay, so here's General Motors. So General Motors, if you go in, pull the filings, you can see that they did $34.2 billion in revenue for the second quarter. And so that's about $140 billion run rate. If once again, autos are seasonal, so it's gonna fluctuate. But their earnings came in at $1.97 a share. General Motors North America did almost $3 billion of EBITDA, and international looks as though it was flat, and then financial came in at 1.6. As we all know, a lot of auto companies make a lot of their money off of financing, and you can see that the cash flow of their auto, actually of producing the vehicles versus financing the vehicles, is about 33% of their cash flow is coming from their financial, them financing the vehicles, which goes to show you how much the finance industry makes. So the year ago, the revenues were 17 billion, 16.8. You can see that last year, sales collapsed. So it's literally doubled off of last year's low. And last year, they had cash flow of a negative 9 billion. So right there, this number here, you can see that they experienced tremendous amount of hemorrhaging like other businesses. And obviously the auto industry has a much higher cost structure, a fixed cost structure. They can't shed the costs of the plants and the union contracts. So they lost a lot more than the average company. Okay. So if we go through the rest, let me see here. We're going to look at their balance sheet. Let's see if they have it reported in here. Every company has a slightly different approach. See, for whatever reason, they're not showing it in their earnings release. Some companies do, other ones don't, and then you have to go and dig into the filings themselves. I'm not sure why they're afraid to show it. Like some companies don't want to just show it all in the report and make you go dig into the filings. But you can see that they're estimating to earn between 540 and 640 this year is what they're saying. So the stock is $53. So right now, if you believe what General Motors is saying, then you're paying about 10 times. You're paying about 10 times earnings this upcoming year for General Motors if you buy the stock. Now let's contrast General Motors with this company called Tesla that we've all heard about. Now Tesla is worth almost 10 times what General Motors is worth. It's worth $705 billion. If you look right here, that's $705 billion right there. That's what Tesla is worth. And General Motors was worth under $80 billion. I think it was worth 76 or so. So if you look here, 77. So it's worth 77 billion. So about 9 times the valuation, 9 times the market cap. And General Motors is on pace to do over 140 billion in revenues. Their revenues have doubled year over year. So now, if we go to Tesla, which just reported on the 26th of last week, you can pull this down, and their report is a little bit different than GM's. It's definitely a little easier on the eyes. They've done a little more finesse in reporting the numbers. And let's go take a look at what their revenues look like. So if you go scroll down, year over year, they also had 100% growth. So on the surface, their revenue went up 97%, which if someone's not paying attention to the other automakers, be like, wow, Tesla's revenue Tesla's revenue was up 100%, but so was GM's. So GM went from about 17 billion to 34 billion. Tesla went from 5.2 billion to 10. Okay, so you can see right there. So even though Tesla is doing 10 billion on automobile sales, now they did total revenue of 12 billion. So there's another 2 billion from something that we need to look at. Maybe they broke it out separately from their automotive revenue. So 1.7 billion more. If you look at this 10.2 versus 11.9, maybe they talk about it a little bit elsewhere in the filing. Here we go. Their solar operations. So the solar operations right here. So they produced 150% more cars. That's what this number is right here. Hold on a second. We got to pull this up. I'm trying to make the print as big as possible, which is very tricky. But you can see that they produced 206 vehicles right here. And last year was 82,272. So 151% increase. Now their storage deployed of megawatt hours went up 200%. So it went from 419 to 1.2. I guess 1.2 billion megawatt hours. And then their service fleet is up to 1,000 vehicles. And once again, folks, I think what they're doing is they're going to build a fleet of vehicles that's going to rival like Uber as well as Lyft, is what I think that they're working on. There's a big move to have these vehicles create these other fleets so that people don't need to have cars. And part of the logic as to what makes Tesla a little bit different than Uber as well as Lyft is that they're going to be making a big push to autonomous vehicles. So if you think about why is Uber and why is Lyft, why are the valuations so high? Well, if you imagine a medallion in New York City used to go for about $1 million at the peak. And so to have a right to be a cab driver in New York, you had to pay $1 million for the right to be a cab driver in New York. Not too long ago, folks, maybe 10, 15 years ago. Sounds like a long time, but it really isn't. And so you have to worry about paying. You got to worry about accidents. You got to worry about somebody not showing up to work. All these types of things. I guess you do. You know, if you own the medallion, you probably really want to make sure your cab is going to pay for itself. And these vehicles, if you can turn around and have these vehicles, okay, not have to need a driver. You know, think about what the payroll savings are. 50, 60, 80 grand, 100 grand a year in payroll. And the vehicles can drive people to where they need to go. It makes sense as to why some of these companies are worth what they're worth. Just to give you an idea, if you pull up, for example, the number of cab drivers in America, we could just quickly look at it. Number of cab drivers in the United States, just to kind of put some numbers with this. Drivers in U.S. And I'm going to pull it up right here so you guys can see what I'm typing. So we'll just go number of cab drivers in the U.S. Now, keep in mind, we're not even talking about the rest of the world. Think about that for a second. We're only talking about the United States. So if there's 207,000 people in the United States that are cab drivers as of 2018, and we'll just say average income of cab drivers, okay, is, wow, look at that, 133,000. Like I said, they're making anywhere from 133,000 to 50,000 is the average, 48,000. So each 208,000 drivers, okay? So if we just say 208,000 times $1,000, that's $208 million, okay, in payroll costs. And so 208 million per thousand. So now if we say 50,000 is the average, then the payroll cost, folks, we're not even talking about insurance, right? You got to worry about insurance. You got to worry about the way the cars are driven in terms of the suboptimizing the fuel usage, for example. And payroll alone is $10 billion. So $10 billion of payroll for the cab industry, folks. Now, keep in mind, if all of a sudden we move to a world of vehicles that are, driverless, the demand will explode as well. No, a lot of people don't think about that component. When you can eliminate the need to have, in a sense, let me just go here so you guys can see my mug. So when the world kind of makes a shift and technology displaces a lot of workers, at first there's a lot of agitation and people get very worked up and very upset about this because we have a situation where if you get rid of 100,000 jobs or 200,000 or 500,000 jobs, people feel that people get pretty upset at first, but then we realize that we're human beings, and as being human beings, we always come up with something else to do. There's always a new set of work that needs to be done. There's no such thing as too much work. And I had a friend from graduate school who used to we used to argue about this issue, and finally what he said to me, he said, Bobby, if you could, would you like to have two personal assistants? that just took care of whatever it is that you wanted to have them take care of. And of course, the answer is going to be yes. I'd love to have 2 personal assistants running my errands, whatever, paying my bills, going to pick up dry cleaning, etc. And he said, don't you think every human being would love to have 2 assistants? So this whole idea that there's a shortage of work is nonsense. Now, there's different types of work that are much higher value add. So if I have a choice between having more and more dry cleaners go into business, right, or have more and more creative people creating things, whether it be good quality entertainment or music or maybe very good books, I'd rather have the latter, which tends to pay a little better anyways. And there's higher networking effects, and those people tend to do a little better because you take a smaller portion from a larger number of people. And so I just want to point this out because, I feel bad for the cab drivers. The really big bang for the buck is going to be the number of truck drivers, because the truck drivers in this country, when this automation takes place, and there's millions of truck drivers in the United States. And I just told you the payroll for 200,000 people, 200,000 people at 50 grand, the payroll was over $10 billion. Okay. So if you have 2 million plus truck drivers and their payroll is 80 to 100,000 because they have higher insurance, they have health insurance also that's much more expensive because they have problems with their backs and so forth from driving these trucks. My sister happens to be in the workers' comp industry, so she tells me that truck drivers, they have problems all the time with their health. It's a very demanding, physically demanding job, and it does a lot of damage to people's spinal cords and their hips and all this because these things are massive vehicles and they're bouncing around on the roads and so forth. So when I think about this, right, and now keep in mind, there's a shortage of truck drivers in America because I think a lot of the people that are younger in this country realize that there's going to be a shift away from needing truck drivers. So in some respects, the problem is going to be solving itself a little bit because, there'll be autonomous trucks that are driving. But I just mentioned the 10, 11 billion in payroll for 5, that was at 50,000. So now if you imagine 2 million, that's 10 times that number. Okay. So now all of a sudden you're at $100 billion of payroll, $100 billion of payroll. Now truck drivers are making twice the amount on average, all in with benefits. So now you're talking about $200 billion of salaries being paid in the United States to truck drivers. Salaries and benefits. So you can imagine if you're Tesla or you're some of these other companies that are working on autonomous vehicles, you're like, wow, Bobby, $200 billion of payroll savings. If these companies just capture half of it, that's 100 billion. If you put a 16 multiple on it, that's 1.6 trillion. Well, Tesla's worth 700 billion. And then Lyft is worth 80 billion, I think, or maybe it's the other one, maybe it's Uber. So you start adding it up, these vehicles, Uber, Lyft, and Tesla, are worth almost $1 trillion. So right now, if they look expensive to people, you'd be like, wow, why is Tesla worth 10 times what General Motors is worth? Instead of just saying, well, it shouldn't be worth that, which is a natural inclination of a lot of people is to say, doesn't make any sense. But if Tesla is working on autonomous vehicles and has the technology and is doing all this IP, and General Motors is not doing those things, or it's behind the 8 ball, it helps explain why one is worth 700 billion and the other one's worth 80 billion. Okay. And keep in mind, as the more success that Tesla has, the more theoretically you eliminate the need for General Motors type vehicles. Why? Because they're not going to be equipped with the same technology as a Tesla vehicle, or Tesla might, if it keeps it proprietary, it can lock GM out of the market. If it licenses its technology, it's just going to go to the highest bidder. So let's just say Toyota wants to use Tesla's technology and Ford, but GM doesn't want to pay. And so, these are the types of things you need to think about when you look at these industries, is how much is technology disrupting the flow of how these industries are moving forward. Okay, so let's go to, so that's GM. Talking about GM, we talked about Ford, we talked about the difference in the pricing, and what the real value proposition for Tesla is really a massive labor arbitrage. And I know it sounds bad, like I said, we don't want to just wipe out jobs for the sake of wiping them out, but sometimes technology does do that, which is very, very important as to why we should have lifelong learning in this country. There's services like Khan Academy. I think there's MIT courseware. We need more programmers. We need more people in science and engineering. And if you have children, that are in college and high school, even yourself, I happen to be in my mid 40s. I haven't stopped learning. I'm still taking other classes on different things to stay ahead of the curve. I've taken quite a few classes on neural networks and artificial intelligence design, just to understand how to deal with flows of data as the world is changing on us. And so this highlights this with this example as to why you need to continue to do that. Okay, so let's go to this company called Robinhood. Okay, so Robinhood, which is simply goes by the ticker the Hood. No, I'm just joking, just Hood, not the Hood. Instead of living in the Hood, you buy the Hood. So anyways, there's been a lot of buying of the Hood today because this thing traded up to, believe it or not, it halted trading. It hit a high of $85. You can see that right there, $85. It just went public not too long ago. But I want to show you something. So it's $54 billion market cap. So literally 54,000 million. Okay, and that's after it dropped $20. It hit almost $70 billion market cap today. So because this went public, they're not going to have a filing just yet, and like a 10K or 10Q. They're going to have something else called an S1. So if you go to Hood and the SEC.gov here, and you can see this prospectus right here. Came out on 7/30. Today's 8/4, and they show that they issued 55 million shares of stock right there at the top. So Robinhood issued 55 million shares of stock right here, and they issued it at $38 a share. So the price was 38. So they raised cash inflow of a little over $2 billion. $55 times 38 is $2 billion. Now there might be a follow-up offering that could be held, so you need to look at the filing to see that. And sure enough, right here, they tell you they paid $88 million in underwriting fees. This is why investment bankers make a lot of money, folks, is because they make a lot of money because of fees like this. And let me see here. So proceeds to selling shareholders. So some insiders wanted to cash out some of their money. They got $100 million today, $95 million on this day that they went public. So some of those folks, they took the cash from the offering and made $100 million. So if you're wondering why some homes are worth $10 million, $20 million, some people have worked at Robinhood or something, cash out and they get these huge paydays. So, okay, so here we go. Let's go through who went public, who took them public. So Goldman Sachs, whoever is the first listed firm is called the lead underwriter. So this is them right here. This is Goldman Sachs. Actually, it looks like they might have had a joint because they're on the same line right here. You got Goldman and you got JP Morgan. So my guess is they both took them public as the lead. They must have had co-leads, right? It's a really big ego thing. You want to be able to say that you're the one that was the lead underwriter, but maybe they were co's. So we'd have to look to see what was going on there. So here's an interesting mission statement, and I want to go into this one because this one is going to be fun for me, folks. because a lot of people are sitting there wondering, like, how the heck did these guys make money? How does Robinhood make its money? I think that's a damn good question, and we're going to go into the filing and see how they make their money. I was actually going to do this video by itself, just on Robinhood, but I figured, you know what? I'll start out with the boring auto companies. Maybe not so boring with Tesla. That's an interesting company, and then kind of jump into what's taking place with Robinhood. So they want to democratize finance for all. It sounds like a wonderful claim. You know, we'll see how it looks. So here we go. We can go to Tiger Corporation, Roar. Okay. Obviously, I think that's a made-up stock. But, you know, they basically do cash management, Robinhood Gold. They do shares, fractional shares, right? There's nothing wrong with fractional shares. You buy fractional shares, you have no votes, right? Your vote doesn't count. Someone else is voting your shares when you buy a fraction of a share. So from a philosophical perspective, I think this is a horrible, horrible thing in the United States that this is happening, that people buy fractional shares in publicly traded companies. This is a millennial thing, and I think it turns my stomach when I hear this being applauded, because when you're buying fractions of shares, who's voting all those fractions of shares of stock? You no longer have a vote. It's almost like fractional voting, right? Like, you know, in the real world, that is. You guys know what I'm talking about. Okay, so, you know, that's something to think about. So then they got their Bitcoin platform with crypto, and then nice pictures here, the Robinhood platform. We are all investors, but we'll take and vote your fractional shares for you. I don't know if that's the case, folks, but I am going to try to look into it to see if it's in the filing. If they have the right to vote the fractional shares. I have no idea. I'm just speculating right now, but somebody has a right to vote them, and we need to figure out who the heck is voting those shares. Okay. There you go. Let's see here. Okay. They got all the stuff here. They have 18 million people have become clients. That is unbelievable, folks. 17.7 million active users, 80 billion in assets now. Wow. First-time investors. So, you know, to their credit, they've done an incredible job of getting a lot of people that have never invested to invest. So God bless them for that, because over 80% of referred business. Wow, that is amazing. There is no sugarcoating that. This is a big filing, 300 pages. This is not the norm, folks. I don't think these things are usually 300 pages. I really got to see what they're saying in this thing. We're not going to read the whole document, but I do think it is worthwhile to try to understand what the big drivers of this company are. And so they've only been in business for 6 years, if you could believe that. So that's a pretty impressive thing, to go from zero to being worth $50 billion in 6 years. So whoever raised all this money, and they probably cover it in here. And folks, I highly recommend pulling these initial documents on any company that you find to be very fascinating. It's a wonderful book. Like, it's free too. You go to the SEC, everybody has to file these things, and you get a real good glimpse as to what created a particular company that you see in the real economy that impacts a lot of people, right? It impacts a lot of people in this world. And Robinhood, there's no denying it. It has had an incredible impact on the financial system, even though it's a 6-year-old company. And so they, as a result of investments in the past 3 years, they think they can handle 30 times the volumes that they were dealing with in 2000. Wow. They tell you right here. That's unbelievable. 30-fold increase. They're basically telling you we can handle a couple 100 million clients, right? Unless people are trading 30 times the normal volume. So over 50% of our customers. Okay, so here we go. We already heard that. So let's see. First, thinking principles. What I want to do is I would really like to understand what is what are they saying they make their money, right? Because they say they don't charge. And so I think it's important, since they don't charge, how do they get paid? That's the big thing. If somebody's offering to do something for you for free, and you don't know how they're making their money, you really, really need to look into it, because they got to get paid some way, right? They got to generate some revenue to pay their bills, pay all their employees. And so we need to look into, what are they doing to make their money? So let's take a look. So right now they trade in ETFs, crypto, fractional trading, recurring investments, cash management, and then also Robinhood Gold. So I guess that's not actual gold, it's just a different type of service. Okay. So then we're going to go in here and look at their revenues. So it's like, wow, for the year ended 2020, their revenues are up almost to $1 billion. You see that number, 959 million. So right here, 959 million, up from 278. So they've more than tripled their revenues. Not exactly, 245%. Sorry, 245% growth. And they made their first profit, $7 million, compared to a loss of 107. So obviously they were losing a lot of money because they were building out their infrastructure. And then their cash flow has exploded. So now that they have all these people into their system, they went from a negative 74 to a positive 155. So that's where they're at. So then their year over year quarter, wow, look at that. In one quarter, they did 522 million. So the yearly number was 959. So now they're on a $2 billion run rate of revenue, right? At least, because you would think that the growth would continue to go each subsequent quarter. But they recorded a $1.4 billion loss due to convertible notes. Wow, so that's pretty interesting that they lost that much money. I guess they enjoy seeing the tax benefits of that loss. So let's take a look at what they're doing. We still haven't seen how they're making their money. Okay, so the crypto markets are trading. That's where they're making a lot of money. Offers commission-free buying and selling, folks. Unbelievable. It's like, once again, they make no commissions. So we got to find out, how are they getting paid? So let's just go take a look. What's going to do it? All this stuff, you guys can read it on your own. It's interesting to me, but it's not the real sauce. The real sauce is, how are they making their money? Okay. And so, summary of risk factors. So this is an important section that you guys should look at. And okay, risk factors. Summary of risk factors, folks. And they say, going on page 35, this is the most important part of a filing, especially on a new company, and especially on a company that doesn't charge for what they're making their money, right? They don't charge in traditional ways as a broker, right? This is why we've seen Charles Schwab and other firms offer no commissions, because now we're going to find out, well, what do they do exactly that they're not charging a commission? And so the risk factors, and they said it's on page 35. So let's just go right to the risk factors, okay? Because I want to see what those risk factors are. So instead of reading the whole document, I think this is where we need to look, okay? Because time is limited. We can't read everything indefinitely. And so risk factors are PFOF in transaction rebate arrangements with market makers. In the practice, okay, right here. Hold on. Okay, where did it go? Hold on a second. Did I just lose my page? Hold on. I thought maybe when I expanded it, okay. it changed. Here we go. So I apologize. I'm scrolling this around. I wanted to blow up the thing, and it just jumped ahead to page 34. Okay, so right here, I don't understand. Where did that PFOF go? I'm trying to find the payment for order flow. That's what we need to see, folks. So right now, the payment for order flow is gone. I don't understand where it went. Here we go. Okay, so I was on page 40 with this. Somehow I scrolled right to that. Okay, so this is what we need to do. Here we go. Oh, right. This is the fun part of the filing, my friends. Page 39. Because of a majority of our revenue is transaction-based, including payment for order flow, reduced spreads in pricing, reduced levels of trading, changes in our business relationships with the market makers, and any new regulation of or any bans on payment for order flow may be resulting in reduced profitability and increased compliance costs. So a majority of our revenue is transaction-based, and we receive consideration. Consideration is a fancy word for money, folks. That's how lawyers like to talk. What's your consideration? How much cash are you getting? So we receive payment, consideration, in exchange for routing our users' orders to market makers for execution. With respect to equities and options trading, such fees are known as payment for order flow. With respect to crypto, we call these transaction rebates. Okay? In the case of equities, the fees we receive are typically based on the size of the bid-ask spread. We receive a fixed percentage. Wow, this is the real sauce right here. Between the bid-ask spread at the time it is executed. Holy cow. Okay, I'm going to go back to my mug. This is an important thing I want to talk to you guys about, because a lot of people might be like, what the hell does this all mean, Bobby? Let me put it to you this way. Okay, let's use an analogy of the house, right? We right now know that a lot of people, they own a home, right? And they use a realtor. So I want you to imagine that you're a real estate agent. You know, years ago in the stock market, I'll give everybody some context. Before the Mayday rates in the 70s, the stockbrokers of yesteryear in the 70s used to receive a commission that could be 1% to 2% of the value of what was bought and sold. So if clients came to you and they wanted to buy $1 million worth of stock, they would get like a $10,000 to $15,000 commission. Now, keep in mind, in the real estate market in this country, you know, if you sell your house and it was worth $500,000, the realtors split 5%. They split 2.5% each. So it's $12,500 to one realtor, $12,500 to another realtor. Now, what they're basically saying here is there's a bid ask. So let's just say that $500,000 house, let's assume that they didn't do any work, right? They just create this exchange for the house. And somebody was willing to buy the house at $510,000. And that's, you know, so they're saying, I am a buyer. That's called an ask. I will buy this property at $510,000, right? Actually, I take that. I want to make sure I don't confuse people. Let me simplify the language a little bit. If you're looking to receive payment for what you're selling, you're like, I'm a seller. The minimum that I want to sell something for, in this case, is $500,000. I want to sell my house at what it's worth. It's $500,000. Now, somebody else says, I'm willing to pay up to $510,000. So it's like they're bidding on the house, and that's the ask. So someone's willing to say, I'll sell it at $500,000. I'm willing to pay. I'm messing around here, folks. I want to make sure I'm not doing a good job with the analogy or this example. Let me take it from scratch. Somebody wants to buy it at 500. Somebody wants to sell it at 510. So I would be willing to buy this house at 500. Somebody else says, I don't want to sell it to you, Bobby, at 500. I would be willing to sell it to you at 510. So there's somebody who comes in and says, I will bid 500. Somebody else says, no, Bobby, that's not enough. I want 510,000. Okay. So between the 500,000 and the 510,000, there's the bid-ask spread. Now, the midpoint of that is 505,000. Now, what Robinhood is basically saying is we will take a piece of the middle. We're going to take a cut between 500 and 510,000. And we're going to send your order. So let's just say you want to sell your house and you want to sell it at 510,000. And then there's nobody who wants to buy it right now, but there is somebody that wants to buy it at 500,000. Robinhood will go and say, okay, Bobby, you want to sell it at 510. We're not the good platform for you. We need people that do market orders. And so, if you do the 510, you're going to sit out there. We don't know if you're going to get that 510. But if someone else comes in and says, I'm willing to buy the house right now, what it's selling for, as a rule of thumb, they should get 500. They should be able to buy it somewhere in the middle of there, because somebody else will come in and say, you know what, I'm willing to sell it at 509. Bobby's being too greedy. He wants 510. So you can buy it from me at 509. But they don't show up, right? It's kind of hidden. Right now, you kind of see who's willing to tell everybody what they want to do. So you have the people that are willing buyers. If you said, here, I will sell you my house right at 500,000, there's somebody that will snap it up immediately. Now, if you're willing to sell it, but now if you're willing to buy and you want to buy immediately, you don't want to wait, you don't want to miss your opportunity, and you bid 510, the way the exchange rules work, if that's the best ask, you have a right to buy it right at 510. So now there's people that are in the middle that they don't want to show their hand as to, they kind of want to get it at 508, but they don't want to tell anybody. And somebody else is willing, so someone's willing to buy it at 508,000. They don't want to pay 510. They don't want to show their hand. So they might send their order to a dealer or a market maker and say, don't show my order. Don't show anybody that I want to buy it at 508,000, because I don't want them to move the price up. All of a sudden, the person that was willing to immediately buy immediately buy at 500,000 might move it to 502,000. I know this gets a little complicated, so I'm trying to do my best I can with this house example. So as this is happening, these transactions, someone who really wants to sell at 510, someone really wants to buy at 500, and then everybody in between. Robinhood basically says, well, if you give us a market order, and you want to, you say, you want us to find you the market maker that will give a better price to buy than the current 510,000, we will get paid to send them the look. That's what it's called. It's like the market maker that we send this to, they're going to pay us a fee. Think of it as like a referral fee. Payment for order flow is like a referral fee. And if they pay us this fee, this referral fee, we might get a referral fee from the other person as well. So it's like acting as an agent on both sides of the transaction. And so you can imagine there's a bit of a conflict of interest here, Because what if Robinhood wanted to send a lot of their business to specific companies only, or specific market makers only, whoever gave them the highest cuts, whoever paid them the most for the traffic. So it's kind of like foot traffic in a retailer. And so, this is why they make it very clear that since the majority of their revenue is payment for order flow, that if there's any rule changes, it can really knock the heck out of their revenue model, right? Because this right here, it says that 81% of their revenue comes from payment for order flows for this type of stuff. Now you might ask yourself a question. You say, Bobby, I'm a little confused. Why do I have to pay, Robinhood for my order? Why do I give them order flow? Well, because you get zero commissions, right? You don't want to pay the commissions. So you say, wait a second, I'm a little confused. I want to keep this real simple. If I pay somebody a commission to buy and sell a stock, then they have to what? They are obligated by law to attempt to identify the best price. So the moment you pay somebody as an agent on your behalf, they have a fiduciary responsibility to try to find the best exchanges. And they use routers, and they try to find where should they, if you're looking to buy the stock and someone's your agent, where should I go and buy the stock? Oh, there's these 5 exchanges listing the stock. I'm going to get this best price. Well, if you don't want to pay a commission, I can't help but think, and I need to look at this, I'm not a lawyer, I can't help to think that maybe you give up your right to best price and best execution. Because by law, the moment I collected a commission on anything, if I was acting in that capacity as a broker, or if I was operating, I guess you could say, as an agent, I need to find the best price. But if I basically tell you, no, you don't have to pay me a commission, maybe in the fine print of these contracts, it says, and I don't have to find you the best price. It sounds silly, but it's kind of like, wow, if this is what they figured out how to do legally, that's unbelievable. That's all I could tell you. I have no idea, folks. I'm just telling you, I've never looked at this filing. This just came out. I've heard that they're making some of their money off of payment for order flow. But I really need to understand what the heck is going on with this. So here we go. As registered broker dealers, they are saying RHS and RHF. Let me put that screen back on here. So right here, they are doing risk related to negative public. Come on, hold on a second. Let me see here. Our clearing operations. So right here. Let's see here. This just moved. Proposed legislation. Here we go. Okay. If our customers begin to disfavor PFOF and transaction rebate practices due to any negative media attention, that would be an adverse view on our business model. Additionally, some customers may prefer to invest through our competitors that do not engage in PFOF. You see that? Or engage in them differently than we do. Any such loss of customer engagement could have an adverse impact. As registered broker dealers, RHS, Robinhood Securities, our RHF, I'm not sure if that's what that one means, are subject to best execution requirements. So they tell you what I just said. You have to get the best price. We could be penalized if RHS and RHF do not comply with these requirements. Okay, which require RHF, okay, the best reasonably available terms for customer orders. They require broker-dealers to use reasonable due diligence. Although a broker-dealer is not required to examine every customer individually, it must undertake regular and rigorous reviews. So there it is, folks. The investigation resulted in a settlement. This is back in May of 2019. They had to pay a $65 million fine. Wow. So all I can tell you, folks, let me go back to this. I'm going to have to look at this some more. But their profit definitely might outweigh the penalties. That is absolutely correct. I think this is going to be a very interesting company to watch. And I think that the regulatory front, I've said this before, obviously I've been in the markets my whole career, and I think that the SEC is outgunned and understaffed and underfunded. We do have the most sophisticated capital markets in the world with the most amount of capital, but we don't have as much in the way of enforcement action as there once used to be. And my estimate is the SEC should be probably 3 to 5 times the size as it currently is. It should probably be $6 to $10 billion a year. They're spending $2 billion, and when you spend $2 billion on financial markets that are worth $100 trillion, okay, it's unbelievable that we've let this happen. And so they might just be playing the law of large numbers. They're like, you know what? Once again, I have no idea how they're doing it. There's so many different rules and there's so many nuances and things. So I have no idea. I would never, ever, ever say that a company isn't doing things properly, because it's just too complex, and you really need to get into the routers and the servers and really dig in and see this. And there's only one agency right now that I think can do this for broker dealers. I'm not aware of anybody else. I think it has to go through the purview of the Securities and Exchange Commission. I don't even know if lawsuits can allow you to look at that information. I don't know if it falls under regulation, because regulation is a tricky thing. There's banking regulators, there's securities regulators, and so all these different fiefdoms within our government have different types of rules that need to be followed. Now, I've traded over 1 billion shares of stock in my career, just when I was at O'Connor in a 3-year period, and I traded over 100 million options. So I know a lot about how the nuances of these markets work and how to pick up money from how to trade them. But I've never witnessed anybody figuring out how to do it on a systematic scale that might require the need for new regulation to occur, right? That's the thing. I'm not saying they're doing anything wrong. They might be doing everything just too good, too right, where them doing that results in an unfair advantage to other participants. Now, for the markets to be truly fair and truly free, you can't have an unfair advantage in the way the exchange works for all the participants of the exchange. It kind of undermines the spirit of the exchange, because you want to take people that are buying and selling, and whoever's buying and selling, they should have the same similar set of, they should have the identical set of rules for how they buy and sell, so everybody knows what the rules are. It's kind of like changing the game of poker. Everybody knows what hands win. You can't all of a sudden change to have one player have a different hand win at the expense of everybody else who's playing different hands. That would never fly. And so from a regulatory standpoint, I don't know where they are with this process and coming up with new rules. But I will tell you one thing. It is going to be very fascinating to watch over the upcoming years, 6 months, year, 2 years, if the SEC does come down on this issue, or sometimes it takes some kind of big lawsuit to mix things up. So maybe when somebody feels they've been harmed on a massive scale, like a large institutional client or a group of clients, it would be worthwhile. What I would say is, if I was an attorney in the securities industry, I would be reading up on all this stuff and really, really understanding all the intricacies and nuances for the upcoming, 1, 2, 3, 4 years, because I think it's going to be a very litigated area of our system. If I had to guess, I'm just speculating. I have no proof or no evidence to suggest that it's going to definitely happen. I'm just saying that I think there's a good chance that something across this entire industry for payment for order flow is going to take place. I just have no idea when and if it ever does. So anyways, I hope you found today interesting. I know I find Robinhood to be very interesting. So I'm still getting used to this camera, so my apologies if I'm kind of looking a little weird on this thing. I'm trying to get used to the camera. I'm used to looking at a lower camera, computer camera. So I hope you guys have a wonderful day, and I will see you guys tomorrow. Have a great day. Thanks.